Welcome to the Explainer. Sometimes a tiny little tax can have a huge impact on the financial markets. And today, we're breaking down one of those, the Securities Transaction Tax, or STT.
So it all kicked off with this notice right here. On September 9th, 2024, the National Stock Exchange sent this out. And for millions of traders across India, it was a pretty big deal. It basically announced that a T-tax on their trades was about to get a whole lot more expensive.
All right, so let's get right into it. What exactly changed? What's all the fuss about?
Okay, here's the breakdown. Starting October 1st, 2024, the STT on futures and options contracts, and these are two of the most popular trading tools out there, got a serious hike. We're talking a 60% jump for futures and a massive 60% jump for options too. That is a significant increase.
So this immediately brings up a pretty important question, right? If you're an investor, you're probably wondering, what even is this tax? And how does it actually work?
In simple terms, STT is just a direct tax you pay whenever you buy or sell securities on an Indian stock exchange. But here's the clever part. It's collected right at the source by the exchange itself. So you don't really have to do anything. It's all handled for you automatically.
Now, this tax isn't new, not at all. It's actually been around since 2004, and its main goal back then was to make tax collection way simpler. It's been tweaked a few times since, but that 2008 change was a real game changer. They changed how options were taxed, making them much cheaper to trade, and boy, did their popularity explode after that.
And for you, the trader, the whole process is, well, it's pretty seamless. You execute a trade, the exchange automatically figures out the STT, takes it out, and sends it straight to the government. It's a lot like TDS, the tax deducted at source from your salary. It's all done for you behind the scenes.
So who actually foots the bill for this tax? Well, it kind of depends on what you're trading. But if you look at the most common stuff, like intraday trading, futures, and options, it's almost always the seller who pays the STT.
Okay, I know we are probably thinking, these percentages look pretty tiny, right? But trust me, they add up, and they add up fast. In fact, STT ends up being a huge chunk of a trader's total costs. Let's break that down.
And here's the real kicker. This tax applies to the transaction itself, regardless of whether you made a profit or a loss. So if you win, it eats into your gains. And if you lose, well, it just makes your losses even bigger.
Now take a look at this. When you strip away the brokerage fees and just look at all the other mandatory costs of a trade, one thing just jumps right out at you. STT is, well, it's the giant in the room. It absolutely dwarfs everything else.
Yeah, it accounts for over half of these costs, 54.64% to be exact. Let that sink in. Out of every 100 rupees you pay in these kinds of fees, almost 55 of them are just for this one tax. It is by far the single biggest expense you have as a trader after your brokerage.
And, an expense that big doesn't just hit individual traders in the pocket. It's so significant that it can actually start to shape the behavior of the entire market.
I mean, it's basic economics, right? Taxes create incentives, and people, especially traders, are always going to respond to those incentives. If you make one thing more expensive, they're going to look for a cheaper way to do it.
In this chart right here, it illustrates that point perfectly. It tells a really fascinating story. Just look at the last decade. You can see this dramatic shift where trading activity has literally moved away from the traditional cash market, buying and selling actual stocks, and just poured into the derivatives market, all because the STT over there was a lot lower.
And this wasn't an accident. This shift was driven by traders being, smart about their money. They spotted a clear tax arbitrage opportunity. The difference in the STT rates was so big that it created this powerful incentive to just trade derivatives instead of stocks.
But wait, the story doesn't even end there. Some of that trading volume has actually packed its bags and left the country. You've got exchanges like the one in Singapore, the SGX, that let you trade Nifty futures, a key Indian market index, but at a lower cost. And naturally, that's pulled some capital right out of India.
Which, of course, brings us to the big debate. With all these effects, all these consequences, is STT actually a good thing or a bad thing for the market?
And as you can see, there are really strong arguments on both sides of the fence. It's a classic economic trade-off, really, a balancing act.
So on one hand, the supporters of STT will tell you it's a fantastic tool for the government. It's super simple and efficient to collect, it brings in thousands of crores in revenue every year, and it helps keep track of transactions which can deter tax evasion.
But on the other hand, the critics have a very different take. They argue that it flat out hurts traders' profits, especially the ones who trade frequently.
They'll say it makes the market less efficient by reducing liquidity, basically making it harder to buy and sell. And at the end of the day, it just pushes business and capital to other countries.
So really, the main takeaway here is that there's no simple answer. STT is this powerful policy tool, right? It has clear, undeniable benefits for tax collection, but it also has these really significant consequences for how the market actually works.
And that really leaves us with one final big question to chew on. For a modern economy, where money can zip across the globe in an instant, does a tax on transactions actually help build a healthy market, or does it hinder it? It's definitely something to think about.